Cloudcast Media.
Drew Schlosberg Spotlight on the Community Show, amplifying the voices of social impact organizations, entrepreneurs, local nonprofits, and other community champions who shape the culture, creativity, and connectivity of San Diego. Brought to you by Mission Fed Credit Union, bringing good things to San Diego for over 60 years. Learn more about what is good for you and good for all by visiting www.missionfed.com.
I'm Drew Schlosberg, and I just tell you, our listeners are always in for a treat when this gentleman is on the studio with me, or in the studio, I should say, with me, and that's Doug Wright. He is the Chief Financial Officer for Mission Fed Credit Union. And Doug, always glad to have you. You provide great content, usable content, something that our listeners love to hear, and I know they're going to be excited to hear what you have to say today.
Well, thank you. Really happy to be here again, and great to see you, Drew.
Well, it's great to see you too, as well. So, I guess we can't talk to a CFO without bringing up the I word, and that is inflation. I remember when you and I chatted about it. I want to say about a year ago. I could be wrong on that. Maybe I'm losing my mind on that. But it's here, and it's robust. And what's the end game?
Oh. That's a good question, Drew. Yeah, the end game is really honestly difficult to see right now.
Right.
I would love to say that inflation will be slayed in 2 or 3 months from now and we'll go back to a more normal environment, but I just don't think you can say that at this point in time. The latest Consumer Price Index reading came out yesterday morning. It was another ugly reading. It was about 8.5%, which is way too high. The core reading, which excludes kind of volatile food and energy, was also around over 6%, which is way too high. And so far, it doesn't look like the things that we've done have been very effective in fighting inflation, and particularly the kind of inflation that impacts all of us. We all look at rising prices in terms of shelter, which is rent and home prices. We look at food and what food is doing, and that's going up substantially and continues to go up substantially. And then we look at energy prices, and although we've had kind of a back and forth, and particularly in California on gas prices, paying over $6 a gallon is not something that any of us really enjoy doing that. And beyond gas, which fluctuates back and forth, I think all of us are struggling with increasing utility and home heating and air conditioning costs as well. And unfortunately, I don't see those necessarily slacking off anytime soon. The factors that are rolling into higher food, higher energy prices in particular are related to a lot of it is related to the supply chain disruptions. Some of those are getting resolved, but there's also war and weather. And war doesn't seem like it's getting any better at this point in time. And we've had a really tough couple of years from a weather perspective, and that's impacting crops and food delivery and all of those types of things. And those are things that the Federal Reserve, who's our chief inflation fighter, are not able really to control from that perspective. So I'd love to say that it's going to be a whole lot better in the next 2 or 3 months or even 6 months, but I don't think you can say that at this point in time.
Right. So the question is that, and when you see such dramatic increases, it almost seems like it was overnight. And of course, it's not really overnight. It's been building. We get that. And we know the pandemic just absolutely put a kibosh on the supply chain. And then you had like 300 ships, like hanging out for a year that couldn't come into port for other reasons. That's going to have an impact. Are we facing that impact now? Then, because we didn't really face that 2 years ago, and it's just starting to manifest itself now?
No, I think actually, some of the supply chain things are actually getting better.
Yeah, you were saying that.
We don't have 300 ships sitting outside the port of Los Angeles or Long Beach anymore.
That's right.
We don't have some of the other issues, warehouses full and not being able to transport. Some of those things are actually getting resolved. So we're transitioning out of some of those supply chain disruptions. but they've been replaced by the things I was just talking about. When you talk about, the war in Ukraine and Russia, they were both major and continue to be major exporters of kind of some of the key things that go into a lot of different products. And
like wheat?
Yeah, like wheat. And that's not getting better, and we don't know when and if that's going to be getting better. So you have that issue. And as I said, we've had some weather issues. And the other thing that's factoring into it is we have a really tight labor market in the U.S. And there's just not enough people to deliver the goods and services that we're all reliant on. And what that means is for people to be able to deliver, organizations to be able to deliver those goods and services, they are still searching for people to do that and paying higher prices in order to do that. And they're passing those higher labor costs on to the consumer in terms of higher prices for food, energy, and anything else.
Yeah, I want to ask you that question. We're chatting with Doug Wright. He's the Chief Financial Officer for Mission Fed Credit Union. I'm Drew Schlosberg of Cloudcast Media, as you're listening to another edition of Spotlight on the Community. So I shake my head a little bit on this because you go, all right, restaurants is probably a good example, right? But you can go through the list of other businesses, and everyone seems to be shorthanded. But restaurants really come to mind. And why is that section closed? Because we don't have enough people to open it. Where are these people finding work, and how are they supporting themselves when you see rents going? Well, to use San Diego as an example, it's a pretty prohibitive place to live if you're paying rent in San Diego, is it not?
Yes, and that's a really interesting question, because if you take a look at the stats from 2 years ago, just pre-pandemic to where it is now, the number of people in the labor force, or the labor force participation rate, is still not where it was pre-pandemic. So we have fewer people working and fewer people seeking a job than we had 2.5 years ago. And so that's creating some of the shortages. And there's a variety of reasons for that. Number one, a lot of people retired early. And maybe some people will be coming back as they have...
as the stock market takes all their IRAs away? I mean,
exactly. As they see 8% inflation and the stock market down 20-25%. Some of those people may be filtering back in the economy. You have other people who are honestly and sadly still impacted by COVID. Either they're still ill...
Good point.
Or they have childcare issues and can't work full-time because they can't find full-time daycare, or because they're scared and they don't want to go into those high visibility, like restaurant jobs, and those types of things. So that's impacting us. The other thing from a labor force standpoint that's impacting us is a lot of people have moved away from organizational positions and are trying to do things, more on their own. They're part of the gig economy.
Sure.
They're doing something creative on the internet, or they're doing something else that isn't working in the restaurant, but isn't necessarily not working. It's just we're not seeing the results of those efforts.
Right. So we talked about the Fed, and the Fed has been one of the ways to combat the inflation is to increase our, mortgage rates. We'll talk about mortgage rates on these right now. And now they're are they at 6 or something like that? Maybe even higher. I don't know. And when it used to be just, foolishly low at 2%, whatever the case, which we knew was fantasy land, but still. And so that's not working. Easy to be an armchair quarterback and blame someone for that. Are they going to continue to raise the interest rates?
Yeah, I think it's very likely that the Fed, in fact, they've basically communicated that they're going to raise interest rates. So we've already seen a historically quick rise in rates. And I think they've got another meeting in early November and another meeting in early December. And I think the meeting in November, they'll probably raise the Fed funds target rate another 75 basis points, which is 0.75%. And based on the economic data we're seeing, there's a good chance in December it'll be another 0.75. So if you add all of those together, that's going from a 0% overnight Fed funds target rate up to about a 4.25%, 4.5% within less than a year. And that is a substantial impact on all the markets. One of the things to keep in mind, though, is that typically when the Fed raises rates, there's a lag time between how it really impacts the economy. And traditionally, that lag time has been 6 to 9 months. So we may not be seeing the impact yet of some of the earlier rate rises, and we may not see some of the impact of the rate rises still to come until mid-2023 or later 2023. And so it'll be really...
Does that mean recession?
From my perspective, yes. I think that probably means recession.
So, here it is. We're October the 14th in 2022. And listen, if everyone could predict with crystal balls, we'd all be putting 6 numbers down, and we'd all be walking away with, well, it wouldn't be $449 million because we all would have won. We'd probably walk away with $1 each. But, in that aspect of it. But so what do you do to prepare, as some people who, and this is a good question for you. How many people are actually invested in the market, okay, whether it's with bonds or mutual funds or stocks? And I guess that's sort of a loaded question because you can have $15 in the market, I guess, right, which is versus, $500,000 or whatever the case may be. Is that a big percentage?
Yeah, it actually is a big percentage, and it actually grew over the last several years,
right,
and particularly it honestly grew during the pandemic.
Right.
And so I can't give you the exact percentage, but it's well over 50% who are
right,
invested in some way in the market, whether
right,
they have individual holdings or through a 401k or IRA
right,
or something like that. So a lot of people are impacted by a downdraft in the market. Mm-hmm.
And I'm going to say, if you're relying on whatever dividends you're getting from that, or whatever the case may be, maybe that's a stupid way of investing, mm-hmm, but you have to rely on some of those. The question is, am I pulling it out and putting it in cash? That's always a question for somebody, mm-hmm, in that vein. But listen, I don't know. Do you see a tipping point where this thing is now mid-2023 and now we're on a full-blown recession? It won't be 2008 like, will it?
I don't anticipate it'll be 2008 like. Mm-hmm. I think there's a couple reasons for that. Mm-hmm. Number one is because we do have fewer people in the labor force altogether. So the unemployment rate is likely to go up, but it's not going to hit the 10 or 12% rate that we saw in 2008. It's probably, I would say, a reasonable range if you believe the Fed is 4.5%. If you believe some other economists out there and so on, it may be upwards of 6%. And that's painful, but it's not close to what we saw in the Great Recession, for example.
Right.
So that's one rationale. The other thing is that, honestly, households are in better shape this time going into this rough period than they were pre-2008 or pre some of the other recessions because of everyone having jobs, and because people were able to save during the pandemic, and because the government also helped us with stimulus checks and so on. The level of overall debt in terms of household income is not as high. The overall household net worth and savings and so on is higher. So people are entering this tough period with a little stronger, I guess, balance sheet than what they had before. And that will probably tend to temper how deep a recession might be at this point.
Yeah, we come back from break. We're going to continue the conversation with Doug Wright, Chief Financial Officer for Mission Fed Credit Union. He's going to give us some ideas of how to maybe deal with some of this stuff. Some just, maybe some budget wising and shopping, thoughtfully. A lot of these are common sense. But we're humans, and humans don't think sometimes in common sense and think of some other ways that we can, save and be prepared for some of this. And when we return on Drew Schlosberg, Spotlight on the Community Show on Cloudcast Media, brought to you by Mission Fed Credit Union, bringing spectacular things to San Diego for more than 60 years. We'll be right back.
When you do your banking with Mission Fed, you get great rates on auto and home loans. That's good for you, but something good also happens for a lot of other people. We're not for profit, so we put money back into the community to help lots of great nonprofits to keep San Diego strong. So you're not just getting something good, you're doing something good. Come to Mission Fed. It's banking that's good for all.
Brand amplification is the DNA of Cloudcast Media, and our code is the powerful blending of sound, voice, and storytelling to lift local brands and their communities. Whether it is our Brandcast, Schoolcast, or Causecast platforms, the unifying ethos is all about this community, the one you call home. If you dare to dream and want to explore the brand amplification of Cloudcast, a national leader in local podcasting and other Winfluence strategies, please visit us at cloudcast.us.
I'm Drew Schlosberg of Cloudcast Media. You're listening to another edition of Spotlight on the Community, brought to you by Mission Fed Credit Union. And we are here with Doug Wright, CFO for Mission Fed, talking about inflation and maybe recession, who knows, down the road, and where we are, why we got to this situation, and so forth. And of course, it's anyone's guess where it's gonna go, but that's something that Doug studies quite a bit with his fella economists and so forth. So if this continues to go this direction, and there's really maybe no reason to think it's going to be changing a lot, but we'll see. We know the raising of interest rates has not had much of an impact at this point. Mm-hmm. What would get it to have an impact? I mean, does it have just to go off the rails where no one can borrow anything?
Yeah, I think that, the Fed is definitely committed to raising rates to get the target inflation rate back to their target of 2%.
Right.
That's a far cry from 8.5%.
Right.
So if you believe the Fed, they think they need to take the Fed funds target rate up another 1.5% from where it's at. Other individuals and market experts think they'll have to go higher than that, they'll have to take rates higher than that to get to the inflationary result that they want to see. So, I think, I guess I would make an odds-on bet that rates are definitely going to go higher, at least for the next, 8 to 12 to 15 to 20 months. And so if you are in the market for something that requires lending, I think you can anticipate that you'll be paying higher rates. You're already paying higher rates, substantially higher rates. 30-year mortgage rates are teasing around 7% right now. Auto loan rates are going up rapidly.
Oh, I know.
And so it's just not honestly a great time to borrow, but it's a better time probably to borrow now than it will be 2 months from now.
And I was going to bring that point up to you. Not that we ever want to go back to 19% mortgage rates, but us folks who are a little bit older remember that. Mm-hmm. And it stuns. What do you mean 19%? Oh yeah, it was 19%. Yeah. And then when it went to 2%, people who used to be at 19% and remember those days just still can't believe it. Really, a 7% interest rate, when you look at the world, is not that bad. It's easy for me to say that and be an armchair quarterback, but based on where they've been in, somewheres down the road, really isn't horrible. And to your point, all right, you can sit it out, but now if you really needed to buy something, it just went to 9, okay, because you waited too long or whatever. But but who knows? What do people do, Doug, as this comes in? Obviously, trying to hold on to as much money as you have is probably a wise thing to do, is it not?
Yeah, absolutely. The first thing I would recommend is don't consider this as a short-term aberration. Even if inflation comes back to 2%, that means that prices are rising 2%. That doesn't take into account that you're already paying 10, 12, 14% more than you were a year ago. So in terms of looking at your budget and adjusting your budget, think about that. And this is not a temporary adjustment. This is something that we're going to have to deal with on a longer term basis. And so therefore, you probably need to take a more serious look at your budget, for now and looking forward over the next 12 or 15 months and saying, what do I need to, can I make some additional changes to balance my budget and hopefully still be able to have some money left over to save for rainy days and down payments on homes or down payments on cars or whatever those types of things that people want to do.
Right. For those people, and I think we've talked to some of your colleagues before, that sometimes we don't do a nice job of saving in this country, even though you said there's some better numbers on that. But I don't know what the number was, but a huge percentage of people only have savings to keep them sustained for another month or two. I don't know what the number is, to be honest with you, but it's not a lot, correct?
Mm-hmm. Yeah.
How do they deal with this? They're literally on the edge.
Right.
If they're working, they're paycheck to paycheck.
Mm-hmm.
If they have their car goes crazy, they're taking the bus. Okay. How do they deal with it?
Yeah, I think that honestly is a really challenge and probably the saddest part of the whole situation when you have really high inflation. It just adversely impacts people who are already living paycheck to paycheck. So there are honestly no easy answers in that respect. The types of things I would recommend is again, taking a look at that budget and really understanding it's what I would call a need-to-have environment rather than a nice-to-have environment. So take a look at all those things that are need-to-have and prioritize those things. And if there are some nice-to-have things, whether it's the latte or whether it's subscription services or whatever the case may be, it may be a time where you need to let those go for a while and find something else to do. In addition to that, I would say that one of the things that has opened up as a result of the pandemic and kind of the gig economy is there are opportunities to do side hustles. There are opportunities to do some other things for people. So that's an opportunity for some people. I recognize that's not an easy choice because it means even working more and harder, and that's not available to everyone, but that's a way to at least help with your monthly budget. And then the other thing is just to look for lower ways, lower prices, lower areas where you spend money. So if you are taking a look at groceries, for example, you may be downshifting from, kind of higher price grocery goods to lower price grocery goods. You may be looking for sales. You may be looking online for coupon apps or those types of things, anything and everything. And there's lots of information available about, kind of money saving hacks and those types of things. So that's an opportunity. Take a look at what changes you can make in terms of energy use. Can you adjust how you're driving, or can you adjust, kind of temperatures around heating and cooling? Those types of things is another opportunity. Probably there's no silver bullet. It's just a variety of different acts. And from a savings and borrowing perspective, look for opportunities to lower interest rates. If you've got a credit card you're paying 18% on at this point in time, look to consolidate into a personal loan at 8%, or look for a zero balance transfer offer where you can get 0% for a 12 or 15 month period. Or, those types of things from a savings perspective. The good news is that savings rates are starting to come up. So all those who have been savers for a long time and not been really happy with savings rates, one of the benefits of rising rates is that saving rates are coming up. So there are opportunities with certificates of deposit and annuities and various other things where you can get a little bit more for your money that you have saved.
Right, and I would encourage those folks, if you do have a financial advisor, check with him or her. They know this stuff. That's what they're experts in, and if they were a good financial advisor, they'll know where your comfort zone is and where your pain points are, and everyone is different in that aspect of it. But seek advice on that, and I think. One of the things people have a tough time doing, Doug, again, we're chatting with Doug Wright. He's the Chief Financial Officer for Mission Fed Credit Union. I'm Drew Schlosberg on Cloudcast Media, listening to another edition of Spotlight in the Community. People don't know how to budget, which to me is one of the most simple things to do. This is what you bring in. You should not spend more than you're bringing in, okay? You shouldn't do that. And literally, you should have a line item for this is what SDG&E costs, this is what cable costs, and then say, do I really need HBO and 75 premium, channels and all that business? But you first have to get to that budget first, do you not?
Right. Yeah, I think, if I could, I guess, give one piece of advice for parents in particular is teach your kids how to budget.
Right.
Because I think that's something that everyone does, and not everyone does really well. And as you said, it can be done. It's more challenging for some than others, but to just lay out your monthly income and your monthly expenses gives you a good sense for where you're spending your money and where you might be able to save or where you might be able to add income. And then you can have an internal discussion with yourself or a discussion with your significant other about what's most important to us. And what budgeting really does, in addition to allowing you to, make ends meet, is it allows you to establish priorities and figure out what your priorities really are. And that's beneficial not only from the strict money and dollars sense, but that's also important in terms of how you live your life. And you figure out what makes you happy, what you can do and what you can't do. And I think that's a good discussion and a good framework to build a life around beyond just the specific financial aspects.
Yeah, no, I agree 100%. So does Mission Fed offer classes in that and how to budget, how to manage your money, how to, what this means with an interest rate and so forth and everything in between?
Yeah, absolutely. We have all sorts of resources available. We have web-based resources on our website. So certainly there's lots of tips and tools and sample budget worksheets and videos and those types of things that teach budgeting. We also offer in-person counseling or over-the-phone counseling as well. So we have people who are specially trained and specifically dedicated to helping our members and the community at large with budgeting concepts and how to manage debt effectively, how to begin savings, how to begin investing, and all of those things that will build financial wellness and health, which is really what we're here for. This is what Mission Fed does, and what our goal is to build the financial health of our community.
Yeah, I think that's really important advice in this aspect of it. But you said something earlier that has been talked about in, I guess, economy classes probably since they had the first one in 35,000 BC. I'm not sure, needs versus wants. And you have to be honest with yourself, on that one. And it just comes down to, do you really have to have this? Because if you have to have this, okay, fine, that's good. Maybe it gives you mental stability because you have something that's important. There's something to be said about that, right? But if it causes you to continue to go in debt and yank money out of savings, or if you don't have a savings, put it on your credit card, that's no bueno, is it?
Yeah, that generally doesn't lead to long-term financial or emotional happiness.
Right.
What I would say is that there are certain things that may be important to you, and you want to again prioritize those things. But if this particular thing is important to you from a happiness perspective, then what else may you give up that is not creating happiness for you or your family or whatever? And those are the kinds of discussions that I think doing the discipline of budgeting can lead to. And the decision-making process is not all just about doing the spreadsheet calculation or the Mint budget calculation or whatever. It's really about having that conversation internally and with the people in your family about what is important and what can we sacrifice or what can we give up and what do we not want to give up.
Right. Well, listen, Doug, Wright, as usual, the content you provided is outstanding. My takeaway is we're going to be in this for a while, okay? This is something that's just not an aberration. Most likely not going to turn around in 2 or 3 months. Could be a couple more Fed increases. Of course, you never know till you get there, right? Exactly. But I think that's good advice. So don't think this is going to be stopped soon. So start paying attention to it. I should have been paying attention to it a while ago in this. Any other advice for our listeners?
I think just... be patient and look for the things that you can control and focus on the things you can control. There's a lot going on in the world that we look at and we cringe about, but those aren't to a great degree things that we can control. So I think we have to really focus on those areas and aspects that we can control.
No, I think that's great advice in this, and do a budget, but take a look at Mission Fed's website. They offer a lot of the workshops, counseling, advice. Do you have to be a Mission Fed member to take?
Absolutely not.
Yeah.
Our services are available to the community, and we'll be happy to help anyone.
And that's another great advice. Doug, as always, just great content. I know that you will come back on again, and when we come running to you and talk even about more, and maybe not a bad idea somewhere in maybe after the first of the year,
okay.
And see, where is it? Did these rates come up? Other advice we have to do things. Are there programs for people that need relief and so forth? Something to think about.
Okay, absolutely. Looking forward to it.
Always a pleasure talking to you, Doug Wright. He is the CFO for Mission Fed Credit Union. I'm Drew Schlosberg, and you've been listening to Drew Schlosberg's Spotlight on the Community Show. Cloudcast Media brought to you by Mission Fed Credit Union, doing wonderful things for San Diegans for more than 60 years.
You've been listening to an episode of Drew Schlosberg's Spotlight on the Community Show, amplifying the voices of social impact organizations, entrepreneurs, local nonprofits, and other community champions who shape the culture, creativity, and connectivity of San Diego community. Brought to you by Mission Fed Credit Union, bringing good things to San Diego for over 60 years. Learn more about what is good for you and good for all by visiting www.missionfed.com.
Cloudcast Media.